Using donor-advised funds or QCDs, you make your giving sustainable. You make it much more efficient. You help others without hurting your financial plan, even helping. So much like we have our green light spending, our green light distribution schedule to give you permission to enjoy retirement, to live that better retirement, this is one of those green light decisions. Using things like donor-advised funds or QCDs, it gives you permission to do the giving, to feel good, but also feel good about your retirement.
Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor Mark Struthers takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address not just the financial part of retirement, but also the social, the physical, and the emotional parts of retirement. Everything you need for healthier, a wealthier, and a happier retirement.
Welcome to the Healthy and Wealthy Retirement. Fall is here. Halloween is just around the corner. And after all the trick-or-treating, the goblins, the ghosts, it's time for Thanksgiving and Christmas. It's time for giving. That giving spirit starts to take over. I am amazed at how generous many of my clients are. They really want to do good. But quite often, especially nearing or in retirement, it can feel scary. As you start to approach retirement, there's natural anxiety. Your ability to earn, your margin for error isn't there. So being able to give in a tax-efficient manner is critical, even if numbers look perfect. Being able to give and get some tax savings can give you permission. We talk about, we have our green light distribution method, and we use that because that gives you permission. It allows you to spend more without the fear. It allows you to enjoy retirement, and the numbers say it's true. It's a smart way of spending. Well, when it comes to giving, there are two things that we use that are fantastic. One is called a donor-advised fund, sometimes a DAF. For those of you that know dimensional funds, a mutual fund family, don't be confused with DFA funds. DFA funds or ETFs, that's a totally different thing. These are donor-advised funds. So a qualified charitable distribution or QCD. I know these little acronym things are annoying. All industries have them. So we will try to make sure we make it clear what we're talking about. When it comes to charitable giving, what Washington does is critical. And it seems like Washington's behavior on both parties really has us on our toes. It requires a lot of being proactive. But planning is critical in general because it can relieve that anxiety. It can give you permission, but especially when it comes to things like giving. One major issue that popped up a few years ago was the increase in the standard deduction. The standard deduction got so high that it didn't pay for many people to itemize. And many people would say, well, why should I give money to my charity if I don't get any additional tax benefit? If my standard deduction is, it's not this way now, but let's just say that for round numbers, $20,000. And before the standard deduction was lower and I got an extra $1,000 off my income because of my charitable contribution, now I don't because my itemized deductions don't reach $20,000. Why should I give? Now, many people just say, I'm going to give because I like doing good, and that's fantastic. But what if there's a way where you can give, you can help people, and you can still get that tax deduction? That is where donor-advised funds come in. I like donor-advised funds even before the increase in the standard deduction. Some people call them charitable IRAs. To help understand the donor-advised fund, it is good to think of it in terms of your own little private charity. And what does that mean? Well, you create the donor advised fund, but it's actually your account is with a charity unto itself. And you can name your donor advised fund. My dog's name is Pebbles. So we'll say we have a Pebbles Donor-Advised Fund. And Pebbles wants to take advantage of as much tax breaks as she can. She wants to give to shelter charities, shelter pets. So in order to make sure she gets the maximum, she often will contribute in high tax years, or she will also try to make sure she's contributing so she's above the standard deduction. So she can make a contribution to the donor advised fund. And what folks started doing after the increase in the standard deduction is they would bunch gifting. So maybe Pebbles used to give $5,000 a year, but with the new rules, she wasn't getting that full $5,000 off her income. So now she contributes lumps 5 years at once to $25,000. And that way, some or all or most of that $25,000 is above the standard deduction. Therefore, she gets that additional tax benefit. Now, this is an irrevocable gift to, you can call it your charity. But as you might guess, there are rules. There are organizations such as American Endowment Foundation, Schwab, Charitable, Fidelity, Vanguard. They all have different separate little donor advised fund charities. Their job is to make sure that the gifts, the grants, the charitable contributions you're making out of your little charity are going to real charities, approved charities. So you don't necessarily have complete control. That's why charitable IRA is a term you hear a lot. I don't fully like that because you can't gift the money to yourself with a penalty. Once it's in that donor advised fund, it has to stay there and it has to go to an approved charity. But you still have control because you're the one who suggests the grants. You're the one who tells we'll use Schwab Charitable. Say, Schwab, this is where I want the money to go. They'll approve it. And unless it's something really suspicious, I've never seen one rejected. And then they make the grant. What makes this really cool is you can make, in the case of Pebbles, say it was $25,000, and say Pebbles doesn't feel like giving any money for the first 2 years. That money can sit there, and money can be invested, it can grow, it can earn interest, dividends, you can invest in risky assets. And then say in 2 or 3 years, Pebbles wants to start contributing again. She could do $1,000 a year, $2,000. She could keep it going indefinitely. Now, some of these firms have minimum amount in order to manage these donor advised funds. But that's where I like these, even without the standard deduction being higher. I think it's great that you're able to make that donation to the donor advised fund. You get that immediate charitable deduction in the year you contribute to it. And then you can gift to charities over time. You could change charities. Say if you want a charity you normally gift to, say you don't like what they're doing anymore, or things change. So you get that immediate deduction. And then as you might guess, the donations or the grants outside from the donor advised fund no longer have a tax deduction. You get that one-time big tax deduction if you're bunching. Now, some folks, because they like the donor advised funds, for one thing, it's anonymous. The shelter, that charity that Pebbles likes, all they see is, she could call it Pebbles, or she could call it Acme Donor Advised Fund. So it's really great. The other great thing about it is that you can contribute appreciated stock. So, of course, with most charities, you can contribute appreciated stock too. Why would you do it? Because you would avoid the capital gains. So when you think about the federal side, the capital gains could be well over 20%. And the state side in Minnesota or other high-tax states, the same in Minnesota, you can think almost 10. You can save a lot of taxes by gifting that appreciated stock. You get the current market value, and that capital gains happens within your little charity, so there's no tax on it. And then you can invest. So we gift appreciated stock to donor advised funds all the time. And we often will invest in risky assets. And as you might guess, some folks, they make donations or they don't, and the size of their donor advised funds have shot up a lot. Some folks contributed, we'll say 25,000 several years ago, and just through the equity and the dividends and everything else, their value hasn't changed much. So it can really enhance your giving. And that's where it does give you a lot of control. You say Schwab, you have an account at Schwab. You can have, in the case of Sona, we manage the assets. We balance their gifting strategy with risk and return. So we have liquidity and we have interest and dividends and we have growth. And then we work that around their anticipated grants. The one word of caution is you don't want to be 100% invested in really risky assets if you plan on gifting a lot in the next year or two. You don't want to run into a 2009 type event where the market's down 40% and it lasts several years before it comes back. So donor advised funds are really a great way of managing your giving in a very tax efficient way, especially when you can bunch assets together. And it is a very, very good way of handling appreciated stock. Again, you can gift appreciated stock to a charity, but let's say that you want to do several charities. It might be a lot easier to gift that stock to, or mutual funds, to your own donor advised fund, and then donate from the donor advised fund rather than trying to handle moving shares to 4 or 5 different charities. Another retiree secret weapon, and this really is for retirees, are the QCDs, or Qualified Charitable Distributions. These really have to do around RMDs, required minimum distributions. So once you get to a certain age, that age has been changing. Used to be 70 and a half, and for many people, it's going to be up to 75. But that's where the government says we're going to force you to take distributions out of these pre-tax accounts like 401ks or IRAs, and we want our tax money. One FYI is even with the change in the age, the QCD age has not changed. It's still 70 and a half. So you can still contribute to your charity. So this is where, say from an IRA, you contribute directly to the charity, and the way it is accounted for on your tax return, it is much more attractive than simply having a distribution, paying the taxes, and then taking the deduction. It's the way it comes through on your tax return where that deduction happens. So, and the amount most likely will change from year to year, but you can give up to $105,000 in 2025 from your IRA directly to a charity. It lowers your AGI and possibly your Medicare premium, so the Medicare surcharge. There's no need to itemize. It could reduce your tax on Social Security. It doesn't have to be all or nothing. Let's say that you had an RMD of $40,000, but you need $30,000 to live. You could send $10,000 directly to QCD to meet your RMD and avoid some extra income tax. So, and again, the way it comes through on your tax return, it is more advantageous. It saves you money. So I've seen folks use this a lot. If you don't need, if for folks that don't need some or all of their RMDs, it is a very tax efficient way to make sure that you take advantage of your giving. Word of caution here too, to be careful how you invest. Again, you don't want to be investing in risky assets if you are contributing a large amount to a charity each year, because you don't want to necessarily have to sell when the market is down. So which one is right for you? Quite often with folks, we use both. But some rules of thumb, say you're under 70 and a half, a donor advised fund may be best. A QCD is not available yet. And again, even if you're of working years, if you're charitably inclined, these can be a great way of controlling your giving. And the cost of these have come down a lot. The cost of many of the folks who manage the donor advised fund, not the investment side, just to make sure the giving and everything is on the up and up, has come down a lot. If you have appreciated stock, the donor advised fund is best because you can gift that directly to your little charity. You could sell it, you could let it grow, you can diversify it, whatever. And this is really great for those who have maybe a lot of company stock that's really appreciated. This is a way they can get this, get rid of the capital gains. And for those of you looking at estate taxes as well, now those are less of an issue, except on the state side for many folks. But it's a way of getting it out of the estate as well. So if you have appreciated stock, a donor advised fund is best. You can't do that with a QCD. If you're taking the standard deduction anyway, a QCD might be best. There's no need to itemize. You still get the benefit and then some of your giving. If you want to pre-fund multi-year gifts, the donor advised fund is great. The flexible timing. And that's why I like the controls. The idea that you can take that large tax deduction right away and then gift over time or not at all. You can let it grow. It really does give you a lot of control. Want to reduce RMD income, which a lot of folks do. I think many of you who have done planning with us, those RMDs, retirement distributions, the percentage you have to distribute gets higher and higher deep in retirement, it's like pushing on a balloon. So especially if you're invested in risky assets and they're growing and those RMDs are large, later in retirement, it can really, really, it's surprising to a lot of folks how bad the taxes can get. QCD is a really good option. It lowers your adjusted gross income or AGI, and also the Medicare surcharge. It can reduce that as well. And as mentioned, for many folks, using both is a really good idea. Coordinating both, and this is where planning comes in. Seeing what it looks, depending on your goals and your charitable inclination, seeing what each do to your tax profile now and into the future is really a great thing. One other FYI with the One Big Beautiful Bill, there's a few things. Non-itemizers get a new above-the-line deduction for $1,000 or $2,000, depending if you're single or married, for cash gifts. That's going to help a lot of folks. Itemizers face new limits. Only gifts above 0.5% of AGI are deductible, and the deduction is capped at 35 cents on the dollar. The 60% AGI limit for cash gifts becomes permanent. Meaning, if you're planning large gifts, 2025 is your window to lock in better rules by funding a donor advised fund or a QCD before the end of the year. Also, there has been a SALT cap extension. So the SALT cap was raised from $10,000 to $40,000 starting this year, 2025 through 2029. So if you live in a high tax state like Minnesota, New York, Illinois, California, this may let you start itemizing again. And this can make the donor advised fund even more valuable since you might already be above the standard deduction, but looking forward to other years, you might not. So why not clump those deductions all together and make the most of your tax bracket, your tax deduction. And again, you can still do the same amount of giving and then some, depending on how you invest over time. And I've mentioned this before, if you have appreciated stock or mutual fund appreciated assets, as many people do, now it could be a good time to do it. We don't know where the stock market's going to stall out, if it does. But when you think about giving and you're trying to maximize the tax benefit, it's a combination of looking at the tax code now, where the tax code is going, the value of your assets, and those little things like avoiding capital gains can be really a great thing. Giving isn't just about the money, it's about well-being. Generosity reduces stress and increases happiness. There's been lots of studies that have shown this. When we give, when we do things for others, it actually makes us healthier. The science is overwhelming. So using donor advised funds or QCDs, you make your giving sustainable. You make it much more efficient. You help others without hurting your financial plan, even helping. So much like we have our green light spending, our green light distribution schedule to give you permission to enjoy retirement, to live that better retirement, this is one of those green light decisions. Using things like donor advised funds or QCDs, it gives you permission to do the giving, to feel good, but also feel good about your retirement. So before year end, review your plan. Should you open a donor advised fund, start a QCD at age 70 and a half? to help shrink your future RMDs should you take advantage of the temporary SALT window. The earlier you start thinking about things, the earlier you act, the more options you're going to have. So please go out to our website at sonawealthadvisors.com, sign up for our newsletter in the notes below. There's a free year-end giving checklist, year-of-end checklist for those that sign up for our newsletter. And tune in, and certainly you could take a look and see if our free retirement review is right for you. But giving in a tax-efficient way will help you have a healthier, a wealthier, and a happier retirement. Don't forget to hit subscribe. Thanks for tuning in. If you enjoyed this episode, make sure to hit subscribe, leave a review, and share with your friends. Share the love. Make sure they have a healthier, a wealthier, and a happier retirement as well. Also, don't forget to subscribe to our newsletter for free resources and check out our website and social media pages for exclusive content and updates. See you next time.
Sona Financial, LLC, DBA Sona Wealth and Sona Wealth Advisors is a registered investment advisor with the state of Minnesota. All views, expressions, and opinions included in this communication are subject to change. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services. Any information provided has been obtained from sources considered reliable, but we do not guarantee the accuracy or completeness of any description of securities, markets, or developments mentioned.